let's talk about ICICI Lombard. It's recovered from its opening lows, reacting to its fourth quarter earnings. Earlier today, we spoke with the management on their Q4 performance and their outlook. But before that, Yash joins in to give us earnings insights in our special Insight Edge segment. Yash.
Well, Mangalam, let's look at both aspects. A, what does the result for the fourth quarter look like, and why the stock is still under pressure, though it's recovered from the lows, but why is it still under pressure? As far as results for the fourth quarter are concerned, they seem strong. The net earned premium, that has grown at 20%, which is a healthy rate, at about 5,226 crore. Underwriting loss has reduced by 11%, coming in at about a loss of about 210 crore rupees. The operating profit, that is down 26%, but that is largely because of the investment income also being lower to the same proportion in the fourth quarter. The combined ratio has been well protected at 102.5 versus 102.3. Now, the PAT is down about 2% in the quarter. Why the stock is under pressure? That is because uncertainty on two things. One is how will the motor business turn out in the coming financial year, that is FY26, with sales seeing some pressure, especially the two-wheeler sales in the rural pockets of the country. How will that pan out for the motor insurance business of ICICI Lombard? B, the entire insurance sector has been trying for a pricing revision when it comes to motor third-party premium prices, which are in the hands of the regulator. No luck so far for about a few years now. The industry is hopeful that something will transpire in FY26, though the management clarifying to us that there has been no communication whatsoever, no hint whatsoever of any pricing revision in this year as well so far. So that also plays as far as the uncertainty point is concerned. If there is no price revision, it would adversely impact the motor portfolio, increasing the loss ratios, and that creates a fair bit of uncertainty and negative uncertainty as far as that particular stock is concerned.
All right, Yash, thanks a lot for that. Let's also hear out what the management had to say to us.
Across different segments, I think the road that's kind of laid down looks very, very promising. Whether you look at the infrastructure investments and logistics coming in on the commercial lines, pricing uptick again happening in that segment, health looking quite promising, continuing to look to exhibit a double-digit growth, and even motor, I think in terms of how do we see things playing out in the subsequent year, looks promising. So all in all, I think what we would kind of continue to pencil in is to outperform the industry in that range of, as we keep saying, between 200 to 200 basis points insofar as top line is concerned, and obviously a trajectory to see an improvement in combined. What we've been able to deliver is a consistent improvement in combined year on year. That's what we had kind of spoken about as well. And even in fact, at the beginning of the year, honestly, if you look at in our April 24 earnings call, we did kind of expect the market to be slightly more semblance insofar as combined ratios are concerned. But if you look at the 9-month numbers, the industry has actually seen an adverse development in the overall combined. In fact, it has kind of moved by about 100 basis points from 112% the previous year 9 months. So the key thing to watch out for is what direction does the market take? And in that context is how we will be kind of positioning our opportunities. But everything remaining the same, definitely we would want to see an improvement in the combined going ahead. And more importantly, as I said, the return on equity range that we want to continue to start exhibiting to the stakeholders will be within that 18 to 20%.